Okay, let's answer some questions. First one, sadly, you deleted my last answer. No, I don't think I deleted any answers. Maybe the system did it on its own because you used the word Bitcoin in it, or some of the words I used to try to keep the Bitcoin scammers out. As far as the 3-month, 10-year goes, the 100% track record only works because COVID and the following recession hit. We don't know what would have happened in 2020. We don't, but coming out of 2019 and into 2020, the signs were that we were entering a slowdown. So that by the end of the second or third quarter of 2020, lacking any COVID, it is likely that the economy would have stalled to the point of entering into a recession. But you're right, we don't know. But the signs were there ahead of time. It's just that COVID sort of just was an exogenous factor that changed everything. My question is, I had covered calls at 380 with a premium of 900, so I'm out of the market at 389 on Friday. I heard you rolling your calls to December. If you do, that means you believe this rally is just a bear market rally, right? Well, no, it doesn't necessarily mean that, but I do think it is just a bear market rally. I think it's a well-deserved rally. It's more what I'd say is a relief rally. It has some justifiable elements to it, but as I said in Sunday, once we get to 40.50 or 4100, it really starts to call into question the valuation that you're paying for. So there's limited upside here. Your position is different than mine, but I wonder, should I roll the calls or let everything expire and in the future sell a put to enter back? These are very difficult questions to answer because I need to know so much more information. You can observe two people doing the same thing for two very different reasons. You would not then suggest that their follow-on strategy should be the same. So somebody could be selling a call because they feel that the market is topped out and they want to earn extra income. Somebody else could be selling a call because they need to add negative delta to their portfolio to justify having long delta somewhere else. So I may want to add some long positions somewhere, but of the 5 or 6 positions I add, I don't want to be selling calls on all of those. I would like to find one centralized location to sell calls on. And since the 5 or 6 stocks that I add all have a common risk element called beta, I can get my beta hedging from SPY. So I may be selling calls on SPY to hedge a portfolio of long positions, while you may be selling premium on SPY, selling calls to earn income. Well, if the market moves up, you're not going to earn income, you're going to have a loss. Since you're not doing it to hedge something out, your follow-on strategy would be very different than the other person. So you may decide that, well, okay, I'll take my loss here, that was a wrong move, whereas the other one that's hedging may say, I'm okay with these losses over here because I'm getting my beta gains over there along with my alpha gains. So if I have a long portfolio that I feel has some alpha in there and I completely hedge out beta, I can lever up my portfolio because I'm levering up my alpha and just say, beta is not going to take me down anymore. I am market neutral. And in being market neutral, I'm hoping to make the alpha, and I'll lever up to make that alpha as opposed to being subject to beta. So that's a long answer to your question. The short answer is never think that two people doing the same thing are doing it for the same reasons and thus would have the same follow-on strategy. Next one, do you think we are entering a commodity super cycle? I do. These are big, long 30-year cycles. So you have 15-year growth cycles, 15-year contraction cycles, 15-year growth cycles, in and around. The last big cycle ended around 2008, 2009. So if you add 15 years in, you're 2023, 2024, which would, this was the peak of the last one. You'd be down here somewhere, we're over here, and we always, markets tend to anticipate what's going to happen, which is why I've been talking about mining stocks, because I think that what we have going on, especially with the transition, if that is going to continue, the EV transition, which is starting to look, it's starting to be questioned. I'm starting to see more and more articles questioning the reality of actually getting this done, and the reliability of actually getting this done, transitioning, the whole grid to something. Well, I'm going to use air quotes here, greener. I've made the case that EV, running your car may be green, but getting it to that point is not green at all. In fact, it's causing more damage than if you just bought a four-cylinder internal combustion vehicle. But I do think that we are getting close to that super cycle, because we are going to do it. Whether it's going to work out or not is a different story, but the demand for materials is going to increase dramatically. Let's see, in the 40 minutes you mentioned to sell the market when the VIX reaches 20, and that seems to be correct this year. Is the mathematical logic behind this? Oh, is there mathematical logic behind it? Is it due mostly to put call ratios? Every market is different. There are times where, let's take 2012 to 2018, the VIX was fairly low for a long period of time, only because there wasn't a lot of fear, there wasn't a lot of concern. When you have a confirmed bull market, the VIX can be low for very long periods of time. That does not mean that you should sell the market. It is when we have levels of uncertainty, heightened levels of uncertainty, or at turning points in the market. Turning points meaning the market's, hitting a peak and we get some volatility at the top and we're not quite sure what's going on. We start to see some downward action. It's hard to find levels on the market, because technical levels, sure, you can draw your lines on a chart, but you have a big fundamental backdrop, which the technicals are going to be knocked out all the time. When the fundamentals show up, the technicals mean nothing. It's always the fundamentals. At that point, we want to try to get a gauge of how people feel. And you can't really call everybody up and say, well, what are you thinking? How do you feel? What are you going to do? But we can look at the VIX index, because that is a result of action being taken by money managers. If you're buying puts on the index, you're not going to be too concerned when you have to sell, because you will sell only because when you're buying calls on the index, not puts. When you're buying calls on the index, you're not going to be too concerned about selling, because your calls will make up for the loss, so that you can sell at will without worrying too much about the damage you can cause, because you protected yourself with VIX. Your insurance policy will pay off no matter how much damage you cause. So if there's more of that going on, then I know there's going to be more indiscriminate selling, because the outcome's not going to be that bad. At turning points, it tends to work very well. In trending markets, not so much. Okay, do you see this as a bear market rally? Our market is fine moving forwards. The EPS estimate is not priced in the recession, and CPI is still way too far from the 2% target. True on both of those counts. Do you think we are being too optimistic too soon? This is a true statement. If we put a timeline and we say, well, we measured CPI and we look at 7.7%, that is over the last year. You have to look at, well, what will it be going forward? Because if CPI is doing this and you measure it here and you say, well, that was 7.7%, but look at the direction of CPI, it's going to be much lower. And if we looked at core CPI, which we did, and we annualize that, you get to around 3.3% on a going forward basis, which isn't that far away from your 2%, and that is CPI. Okay, the Fed uses PCE. PCE always comes in lower than CPI because PCE shops around. It substitutes. CPI does not. So we'll see the PCE report later this month, and if we look at core PCE, if core CPI annualized was 3.3, core PCE annualized will probably come in lower than 3.3, which is not that far away from 2%. EPS estimate has not priced in a recession yet, but it's very close to pricing in 0% growth. So that is that's already being priced in, or very close to pricing in 0% growth, but it hasn't priced in the recession. But the recession is not something that we can observe and state it as a fact. So that is a probabilistic statement, that there is some probability that there is a recession. So the market has probably priced in the probabilistic level of what EPS is if there is no recession, weighted with the probabilistic EPS if there, so you have, it's easier if I draw it out. You have recession, you have no recession. You might have EPS of 210 in a recession and 235 in no recession, and there might be probabilities here, and you weight the probabilities to figure out what the EPS is, and the market may be pricing in that weighted probability, but you're saying it hasn't priced in this. Well, because a no recession probability still exists, so you can question whether that should exist or not. As far as bear market rally here, I think this is what we've had. We've had a market that's gone down, and I think we have some levels on the index, which I think will probably be within for a while. So I think it's a change in trend. If you look at the trend that we had versus the direction that we're going to be in, I don't think that this is where we're going. If anything, I would say that is our next move, is sideways until there's more evidence that there is a recession. Then I think you have your next leg down at some point, or that there is going to be a soft landing. Then I think it looks more like this. But I think that this is not going to be an option. And it seems that markets want direction more than anything else. Are we going up or are we going down? The idea of are we going sideways just doesn't seem to be one of the alternatives that we take. Either we buy something because we think the price is going up, or we sell something because the price is going down. But if I told you the price of something was going to go sideways, well, what do? Well, there you got to invest for income. So what should we expect to see? Consumer staples, utilities, healthcare, because it is uncorrelated with the market. Anything that has a good solid dividend stream and does well in expansions and in recessions. When I say well, it's got a beta less than 1, so it doesn't do as great in recession, in great expansions, but it goes up. But it doesn't really go down a lot in contractions. So if you start seeing, this being favored, and consumer discretionary and information technology and communications consistently going down, there's the market telling you we think this is going to happen. Which is what I think is going to happen for a while, is we're going to have sideways movement, because we are near the end of the rate hiking cycle, which is going to be good news for the market. It's going to be supportive for the market, but we do have a soft economy, which is going to be negative for the market. But we do have a tight labor market, which is going to be good for the economy, but the tight labor market creates wage inflation, which is going to be bad for the economy. Right now, my weigh scale, if I'm weighing it out, and of course you got a scale like this, right? You got 2 trays, right? And there's the base, and if you put all of the, bear case, bull case, they're about even, which means this is what I see going on for a while at least, with volatility continuing to drop, and probably the DXY being under pressure for a while. I don't see the DXY making any new highs until we have some direction globally as to what's going on. I think the calculation method for cost of healthcare for CPI report this time, we changed calculation, which reduces CPI. Do you think it's fair that we keep changing how CPI is calculated and call it a victory? Well, you have to measure this. So we have this idea that, prices in the economy, there's a price level in the economy. If we think in terms of general equilibrium models, there is some price level. And we can measure that price level by some basket of goods, and we can have a weighting of everything in that basket of goods. the question is, well, we can't possibly look at every price, so how are we going to get this done? And you start by saying, well, here's a nice, an easy and nice way to get it done that would be as accurate as we can get it. Over time, that methodology will improve and improve. Much like our telescopes have improved and improved, now we know more. So if we create a better telescope, we might see something in more detail that we say, oh, we thought it was this, but it's now this because we have a better picture. Would you call that manipulation of knowledge? Or would you call that a progression of knowledge? So I don't know that I would use the word manipulation if your measurement becomes better and better over time and what you're trying to measure comes into clearer and clearer focus. It just means we are closer to having something that is as true a representation as possible. And yes, the methodology will change over time. We would want it to change over time. We certainly wouldn't want to do biological research with microscopes from the 1950s, because there's only so much that you can see, which means there's a whole bunch you can't see, which means there's a whole bunch that's still unknown. Now you have electron microscopes which can see right down to the atomic level, so you can really see the structure of things a lot better. Again, not manipulation, but just progression. Okay, last one down here, and I put this in here not because it's a question, but I want to make a point here. I find I get comments like this more whenever I say anything about Tesla than anything else. If you're critical about Tesla, there's always somebody that comes out, and usually it's the same arguments I get all the time. But I hope to impress upon you a way not to think. Not because I disagree with what this person is saying, but it's just that the way that they're stating it tells me that there's a flaw in the thinking. Musk sold shares on multiple days last week, while Tesla is trading at 2023 peg less than 1. Well, you don't know that. That's an estimation, right? That's 2023 is the forward. That's an estimated. You're just making an assumption about what earnings will be. You can look at the price today, that's objective, but you're making an assessment about what earnings will be. That's an estimated peg less than 1. So you're saying Tesla is trading at this peg. That is written as if it were a fact. That is not a fact. Let's be clear about that. That is an opinion. That is your opinion based on an estimate that you may or may not have made yourself. So Tesla is trading at estimated 2023 peg less than 1 while continuing to grow earnings at 100%. Well, you don't know that either. You don't know that they're going to continue to grow at 100%. You can say, in the past, this is what I've witnessed, and I'm extrapolating forward, but you don't know that. So again, it's another statement of fact that is better expressed as an opinion. It could be, again, it could be an informed opinion, or it could be more commonly a repeated opinion, which means it's not an opinion that you arrived at by being informed on your own. It's an opinion that you arrived at by hearing somebody else state it as an opinion, and then you begin to state it as well, but in stating it, you've moved it from somebody else's opinion to your statement of fact. So you're making two statements of fact here. Heavy downside is priced in. That's another statement of fact. You're making it deterministic. It is. And you even capitalized it to make the point that it is. And it's not just downside. Heavy downside is priced in. You're making another statement of fact. While I think what you meant to say is, in my opinion, the downside is mostly priced in. Because by saying it is priced in, what we're saying here, or what somebody can take from this, is if it's a statement of fact, then there could be no way that it could even trade a penny lower. Because if it could trade a penny lower, then this is obviously a false statement, right? And I'm looking at Tesla now, and I'm seeing that it's trading, well, for way more than a penny lower on a pre-split price. It's under 570 right now, which makes it down over 50% off its high price. So if we're going to say a statement like heavy downside is priced in, and I say to you, are you trying to tell me that it could not trade for 1 penny lower than it is right now? And if you say, oh, it could trade for a penny lower, well, then that's a false statement, isn't it? And if that's a false statement, then all your other statements are being called into question as potentially being false as well. So try to say things more probabilistically. And that's not just for proper language or proper communication. It's so that you don't fall into the trap that the trap of thinking that what you're saying are statements of fact. Because once we start believing that they're fact, we don't see risk any longer because they're facts. The PEG ratio is less than 1 for a year that hasn't happened yet. Earnings will grow at 100% for sales we haven't seen yet. Heavy downside is priced in for a future that I don't even know what it is. You see, those are, if you think more in terms of the uncertainty associated with those statements, not the certainty of them, right? Investing is about managing your risk, is about being paid for the risk that you're taking on. So that we want to be aware of the uncertainty in our statements. And when we say statements with this kind of level of certainty, we don't see the risk any longer. If you look at growth rates, heavy downside is priced in. If you look at growth rates, past growth rates, I think you mean future growth rates. If you look at estimated future growth rates, and if you look at my estimated future growth rates along with my estimated multiples, meaning you, the writer, these are your estimated growth rates and your estimated multiples. You're saying, if you accept what I accept, you must accept this statement of fact, which means it cannot trade for a penny lower. But it can, which means one of your statements are incorrect. Closed loop production has already been organized in the Shanghai factory region as well, mitigating further lockdown effects on output. Not eliminating. You're saying mitigating, but not eliminating. So you are allowing some uncertainty into that statement. This may be your opinion. It may be your informed opinion. If you and I were talking face to face, I would test you just to see whether or not this is your opinion or whether this is a borrowed opinion. I would simply say, what is your view on the trajectory of their operating margins for the last 3 quarters? And if you really had an informed opinion, you would know what its gross margins were over the last 3 quarters, what its operating margins were. And you would have to address that. But if you couldn't, and if you didn't know, I would think, okay, so you don't really know, which means your opinion is not really informed, which means you're repeating an opinion you heard somewhere else, but now you're repeating it as statements of fact, and you're not even aware of the uncertainty that exists. If you were a fund manager sitting in front of me looking for an investment, I'd be done. I would say, okay, well, you're not aware of the risk. Now, Tesla could be a winner. It could be a winner. You know, it could go from where its price is now to $1,000, but the fact that you could sit in front of me and be unaware of the uncertainty in your statements tells me that you don't have an eye towards risk. And because more than likely you probably couldn't answer my operating margin question, tells me that you don't have an informed opinion from first-hand knowledge, but that you're simply repeating something you heard somewhere else. In the end, it comes down to this. It's your money. It's your money. And money in the market gets paid for risk. So you want to be very well aware of the risk that you're taking on. So you want to say statements in the most uncertain way possible, because it is the uncertainty that you get paid for. It is the uncertainty that will hurt you. But once we start saying things as fact, once we start talking about the future as a statement of fact, we no longer see the risk. In which case, we're only gambling, because this may work out, but the next one won't. There will be one at some point that will not work out, and that will be the end of your investing career. And if you're a professional, it will be the end of your job. If you're a fund manager, it will be the end of your assets under management, because it only takes one. Number one, we many times said the Fed doesn't want a rally. Somehow it appears that the rate increase may continue. The market would not stop rallying in anticipation of the Fed's pivot. But stock market is not a component of CPI. Why Fed bothers then if inflation is the target? Why Powell would care what the market is doing? That is like saying steak is not a component of my weigh scale. No, it's not, but if I eat a lot of something, I'm not going to lose weight. If I'm trying to lose weight, the scale is just a measurement device. CPI is just a measurement device. You would not intervene on the measurement device. So I wouldn't try to reset my scale just so that I look like I weigh less and declare victory. I have to work on myself, on my body. And then when I get on the scale, that just measures the change. So it's not as if the Fed is trying to manage CPI, it's trying to manage an economy. CPI is just a measurement of the price level in that economy. And the market itself, the price of equity, is a component in something called financial conditions. So let's take a debt equity ratio from a company. To get the debt equity ratio, it's the market value of debt divided by the market value of equity. If the market value of equity is going up, debt equity ratios are going down, which means borrowing capacity increases, so that that they now have the ability to take on credit. Well, that's what we don't want. You don't want more credit creation, because credit creation brings or pulls forward demand from the future. What we'd like to do is not destroy demand, but push demand far into the future so that we can get an easement on the price level today. Also, it's when prices are going up, people feel better. They start to feel a little bit more comfortable with spending their own money as opposed to saving it. And that creates demand, which will then put pressure on the price level. That's exactly what is trying to be avoided. 3-month 10-year rate always leads to recession. Well, always has led. We don't know if it always leads. It's not physics. There's no real scientific reason why it must. It's not a deterministic relationship. It's an empirical relationship that has 100% success. Empirical means every time we've seen it, this has been the outcome, but there is no reason why it must be the outcome, but we haven't seen it otherwise. So it's an empirical relationship. It has led to a recession, but it doesn't mean that it must lead to a recession. Why is that? So when we see a regularity like that, either there is some rule that must make it so, like the speed of light. We haven't seen anything faster than the speed of light because we think, well, the speed of light is a speed limit. So even though we haven't observed it, we have a belief that we cannot observe it. And here, even though we have not observed a lack of recession, there is nothing that makes that so. So we have to have some reason about, well, why would we witness that regularity absent a strong rule that says we can't? It changes behavior. Usually you get an inversion of the 3-month 10-year at very high rates when the short rates are very high. Well, this encourages savings. So if you have more savings, you have less consumption. Now, there is an identity that savings equal investment, so is that not the same thing? It would be, except banks have way too much cash. They're not lending out that investment. They're going to the reverse repo window, and they're putting it there. It's something like $2.2 trillion. Just hasn't got a home. Because the other thing it does is it makes corporate debt and new investment in CapEx not unprofitable, but undesirable. Most corporate debt is quarterly floating rate, which means it will float at a 3-month rate, but you have a long stream of cash flows associated with that. So if you're discounting your cash flows, you've got to factor in a higher cost of debt because your debt is going to be that floating rate debt. You're discounting it at a higher cost of capital, which makes more and more and more projects net present value negative. And if it makes it negative, then you just don't do it and you don't have that investment that happens. Well, investment today is growth tomorrow. So if you curtail investment for 2 or 3 quarters, well, it'll get to a point where, okay, we have no factories to build, we have no equipment to build, we have no jobs being created, we have nothing that otherwise would have been there in a normal economy. Suddenly that is gone. So you don't necessarily need job losses to create a recession. You just need to have a lack of job openings or a lack of jobs being created. This next one, I find a little bit, this last statement here seems to be almost ironic. Why would a crypto meltdown spill over into other assets? Well, money has to go somewhere, right? And when you scare money, money doesn't just run to the next risky asset. Money usually tends to run to cash, or money is just lost altogether, which is typically what happens in bankruptcies. The other reason is if you look at the crypto market altogether, you can look at the total amount of money in that market in terms of investment, in terms of customer deposits, or you can look at it in terms of the sheer amount of employment and all the industries that support that particular industry. So you're going to have job losses, massive job losses. Well, those are all incomes, and those aggregate incomes are not available for consumption in the economy anymore. Also, there were companies that were supplying services to crypto firms, whether it be prime brokers, whether it be custodial, well, probably no custodial agents, because if there were, some of this stuff wouldn't have happened. You have equipment suppliers, you have demand for all sorts of things, for servers, server time, server space. All of that stuff goes away. So it does have a spillover effect. Now, if this company was, any of these crypto firms were in their expenses were paying money to another company, well, that's that other company's revenues, and on it goes, right? In case of subprime, since housing is connected to everything, I'm not going to quibble over the words. I don't like the words connected to everything. And has a gargantuan I don't like the word there, ripple effect on the economy. It made sense for everything. I don't know if I like the word made sense either, for everything else to nosedive, because everybody, these excessive words, I don't like that either. Everybody believed that housing was a solid investment, and if housing failed, that meant everything else was housing failed meant everything else was also in danger. I'm not sure I like the structure of all of that. There just seems to be you're leading yourself down a path that you think makes sense by making statements that use extreme language, so that you end up being so convinced that what you said was the statement that you can't see how this could be the same thing. If in 2006, 2007, we had the housing supply that we have today, which is an undersupply, you would never have had that crisis, because those houses wouldn't have shown losses. So you had a confluence of a whole bunch of things happen at the same time. You had massive mortgage fraud going on in an oversupplied market. Now, if you have massive mortgage fraud going on in an undersupplied market, you wouldn't have had the housing price crash that you had. It was massive overbuilding in a whole bunch of places, which caused that event. But at the time, nobody thought that there was going to be any spillover. Even Ben Bernanke, chairman of the Fed, in front of Congress, was saying, we believe that any problems in the subprime mortgage market will be contained to the subprime mortgage market. He didn't see anything. Nobody saw it coming. Nobody sees it coming. Because when you have a system with a whole bunch, I shouldn't say a system, let's be clear, a complex system. We don't have a complicated system. A complicated system can be figured out, it's just complicated. A complex system can't be figured out because you have non-linearities which you can't map. You simply can't map out all of the possibilities for these non-linearities. It is the non-linearities that you cannot predict. We don't know if there's any spillover. Maybe there will be, maybe there won't. It certainly is going to affect sentiment. And if it affects sentiment, it's going to affect some people making decisions somewhere. They'll change what they do, which may then affect the people adjacent to them in terms of sentiment, and may affect what they do, and then it may end there. Or it may not, right? We just don't know where it's going to go. So if we look at network effects, if you take a system and you create an anomaly within a system in equilibrium, and there's lots of nice research done on this where we have agents in a system. And let's say you have 1 million agents and each one's represented by a particular node. And you introduce some type of anomaly into the system right here. Well, I'll put a dot right here. And you have some kind of assumption about infection rates, that the people most adjacent, or the agents most adjacent to this agent, might adopt the behavior of this agent with, let's say, a 40% probability. And the ones that are just on the outside of that, 2 nodes away, might only have a 15% probability, and the ones that are 3 nodes away might only have a 3% probability. And that is the first state of the system. Then you go to the second state. Well, some will adopt the same behavior. And then if you say, well, the ones around them may adopt this behavior as well with this probability. And depending on the probabilities that you have, the lower the probabilities, the more it will be contained to a group, and then as you go further out, it sort of just dissipates and disappears. But if it has a higher probability of affecting those around them, lots of research has shown that a system only needs to get to about 20% infection before it hits a tipping point and it spreads. So the idea here is crypto going to have a spillover effect? Even if it doesn't have a direct spillover effect, if it has a behavioral spillover effect and starts affecting the behavior of other people, let's say a bunch of funds that invested in crypto decide that all of that needs to be erased, and they start looking at other things that they're invested in, or other ventures they were going to invest in that might have been proximate to that industry. If they start pulling back all of that stuff, yeah, that could have a ripple effect. Non-linearities, you just don't know. Last line. However, with crypto, most people have a cautious approach. Isn't that an oxymoron? With crypto, I invest in crypto very cautiously. I'm a conservative investor in crypto. Isn't that a kind of an oxymoron? I think that the meltdown in crypto will be constrained within the crypto community. Well, that's, I would have to say, I don't know what to say to that, because I'm not sure what you mean with most people have a cautious approach with crypto. I don't know that that can be true. It's like saying most people who jump out of a plane with a parachute are very conservative. They do it very conservatively. Well, doesn't that kind of just go against each other? Those people who dive in the Cayman Islands and swim with the tiger sharks do it very conservatively. Do you see where I'm going with that? I don't know how this and this can be in the same sentence together. Okay, 3 questions here. First and third are related, so we'll read them both. With a recession still in front of us, with a recession probability increased still in front of us and not fully quantified, why would short-term equity sentiment be on the upswing? Because I added this word, the answer is a little bit easier. And that let's go down the bottom here. Talking about shifts, what surprised me most is shift in narrative. Major theme so far on the market was that inflation will not break without breaking the industry first, meaning that you're not going to get rid of inflation unless you hurt the economy first. Bad news meant good news, because inflation will fall and the Fed will stop raising rates. But the narrative's changed. Recession is still only incoming or ahead of us, and industry is still yet to break. However, inflation seems to be breaking. How is that possible? The market is buying it and rallying. So a recession, the future is never deterministic. We don't know what the future is going to hold. All we can do is have certain probabilities in our mind about what the future would look like. Now, the recession that we see coming, some people have 100% probability that it's going to happen. Some people are still at 30%. And the people who are at 30% will engage in the market as if there's only a 30% probability, and those with 100% probability will engage in the market as if there's 100% probability. assuming a wide enough distribution of players in the market across those probabilities, and let's say equal dollar amounts represented at all those probabilities, because you have some institutional money that believes that no, the soft landing is in play, and you have some institutional money saying no, it's going to be a hard landing, that the market will price in a weighted probability. So when interest rates were going up 75 basis points at a time, the probability might have been 70%. Now that we've seen inflation moderate, it's only one data point, it's true, but we've seen it moderate. We are anticipating that we are at the end of a rate hiking cycle. The probability of the economy breaking might only be now 50%. Well, that means that at the margin, some people are, you have a 20%, I'm using this as an example, there's a 20% difference between the two, so some that might have been sellers have now become buyers at the margin. So somebody that thought it was 50-50 might now think, well, it's only 30% chance or 40% chance, which means I'll buy a little bit more. And so the weighted average of the probability of the recession may have dropped because of that. And because of that, the buyers would have outweighed the sellers. There's also technical reasons, is that as the market is going up, if the fundamental news is good, short positions are going to have to cover, not because they're bullish, only because they're fearful. They're fearful that the run could be a lot more than what they're willing to lose. And as far as the narrative changing, this is what happens. As information comes in, narratives change. Things become more important. I had said this a couple of weeks ago in the Market Outlook that I think November would be the last good month for premium on the SPY, because I think volatility was going to drop no matter what, because if you can get rates, even if they're high, if you can get them to stay flat and stable, it will drop volatility in rates, which will drop volatility in equities. And if you do that, you do have a different market tone and a different market narrative that will go with that tone. And you have to, if you look at the economy and you try to forecast equity prices, that is a mid to long-term strategy. In other words, I'm going to ignore the crowd. I'm going to look at the economy, and I'm going to look at companies, and I'm going to look at earnings, I'm going to look at trends, I'm going to look at all this objective, quantifiable data, and I'm going to determine what is the most likely direction for equity prices by determining whether or not we have an overvalued or undervalued market, mid to long term. But prices don't do this, and prices don't do this. Prices do this kind of thing. They have all sorts of things on the way up because there's all this stuff in the middle. You have a trend, but you have a lot of action around the trend. Even as prices are going up, there's always these pullbacks before they go higher, pullbacks before they go higher. Well, what is going on here? If nothing has changed, if the market and the economy is still strong, why do we even have these sorts of things? Well, this is the crowd, which is why it's important to listen to the crowd. What is the narrative? What are people saying? What is sentiment? Because that will determine what somebody's going to do or what things are going to happen in the short term. Now, the short term, you could say, well, I'm investing in the trend. I don't really care about the short term stuff. Then you can focus on this and ignore all the noise, ignore all the chatter, ignore all the talking heads, ignore the sentiment, ignore all that stuff. But if these retracements can be, 10, 15, 20, sometimes 30%, wouldn't it be nice to sort of be aware of these things and what could change the tone? So a couple of weeks ago, I said that again, with November being the last month for good premium, we are going to have a change in tone with the Fed slowing down, and they will. We're getting to the point where they'll be on hold for a while. That's very different. That's a very different market than the Fed raising rates. That's a market going side where the rates are sideways. So suddenly the rates take a back seat, and what comes up front? Valuations will come up front, which means instead of looking at a market, you're now looking at every individual equity. Some valuations will be great, some not so great. But it is just part of the overall market. Is there are two parts to this market. There's the objective quantifiable stuff that you can look at, and there's the subjective stuff that lives in people's heads, opinions about things, beliefs about the future, because the future is unknowable. And those beliefs and opinions show up in sentiment. Sentiment shows up in moves that may signify a new trend or may be counter to the primary trend. If you think this is a bear market rally, then this is counter to the primary trend, which is downwards. If you think that this is a shift in tone because the central bank is going to be on hold, then it could be a change in the primary trend from a downtrend to a long, drawn-out sideways trend. Which is it going to be? I don't know yet. Next one, in the middle here, can you tell us more about the cash rate and borrow rate? To my understanding, when you are short, you are selling what you don't have by borrowing it, borrowing the stock. So you have to pay interest on it. You have to pay a borrow rate on the stock. And I understand why you will get cash yield by having a short position. I sell a share of SPY, which I do not own. In my account, it'll show -1 beside SPY. But when I sell it, somebody has to buy it from me. So I'll get $399 in my account. So I have $399 that's delivered in my account because I sold something, and my position will show -1. I'm short SPY. Well, there's going to be a borrow rate on that, which is fairly low. The borrow rate might be 25 or 35 basis points. It is really low. But this $399 shows up in my account. Now it's restricted. I can't touch it. I can't take it out. It is part of my margin requirement, but I don't have to hold cash. I can hold a cash equivalent, which is either a 30 or a 90-day T-bill, something that has no duration risk. I can hold some money market security, and I can get a cash rate for that. That is, I can't do anything more than that because that is part of collateral. So your broker will consider cash and cash equivalents as dollar for dollar as part of your margin requirement. It doesn't have to be just cash sitting on in your account. So when you sell something you don't own, you're short the thing you don't own, but you get paid for it. Also, when you say your cash rate is higher than your borrow rate, does that mean IB pays you more on your US cash balance than you have to pay for being short? Well, I don't pay Interactive Brokers anything for being short. I borrowed this from somewhere else. Typically, IB will give me this from another client. And with some clients, you can sign up to lend your shares. If you're a long-term borrower, you sign up with them to lend your shares, and you will get the borrow rate. It's just an extra bit of yield on top of your long position. The harder it is to short something, the higher the borrow rate is. There could be borrow rates as high as 50% a year, 60% a year for stocks that are pretty much going to die. And you need to borrow from someone, so somebody who is long has to be induced to hold them long. And if I'm going to hold it long, I want 70% interest for the year. That's the cost of borrowing my shares, because I know I'm going to lose it, right? Why would IB give you a better rate on your cash balance than on your rate? Well, IB doesn't give me the rate on my cash balance. The money market security gives me the rate. Even if I hold it as cash with IB, I'll get somewhere around 3 to 3.25%. IB will pay me this. However, when somebody is using margin, IB will charge them 4.75 to 5%. So IB doesn't have to go to the bank and say, can you lend us money so that we can lend our clients money for margin? They will say, hey, buddy boy, you've got extra cash. Why don't we give you this much money? And then we will lend it out to somebody else at this. So IB becomes a bank in itself. And as far as the borrow rate, IB doesn't charge me the borrow rate. The borrow rate goes to the person that I borrowed the stock from. First one, where to find break-even rates. I see you showed how to calculate it, but I can't see the reference data in the video in order to calculate it, so I assume you're getting the data from somewhere. 10-year nominal rate minus 10-year tips rate. It's that simple. Just subtract them. Why sell options if the risk-return ratio is upside down? Limited gain, unlimited potential loss. Well, that's the point of selling options, is that is what you end up with. Over time, if you sell options enough, those tail risks should eventually play out and wipe out all of these marginal gains with one big loss. Why do you think that that would happen over time? That's assuming that you have nothing going on and that you take no action. So if I take no action, at some point you will have one big loss, but there's always action you can take. There's always mitigating strategies you can follow if you feel that you're wrong. Everything in the market is based on opinion. Okay? Everything is based on opinion. You think prices are going up, so you buy. That doesn't mean they'll go up. Somebody else thinks prices can't go any higher, so they sell. That doesn't mean it can't go any higher. And of all the decisions that go on in the market at any given time, half of them are going to be right. Every time you buy, somebody had to sell from you. So if the price goes down, well, you were wrong to buy and the other person was right to sell. If the price went up, you were right to buy, the other person was wrong to sell. So everything is an opinion. If you do the same thing every single month, like let's say every single month on SPY, I sell a call and I sell a put at 30 delta. And I do that every month. Well, yeah, at some point I'm going to be wrong because that is only 60% of the distribution. There's still enough of the distribution that could hurt me on repeated trials. But I am not simply flipping a coin and betting $1 on each flip. I'm making conditional bets. In other words, conditioned on what I believe, here's what I'm going to do, as opposed to I'm going to do this without any belief. Selling puts on a stock or selling calls on a stock for income, just saying I'm going to do it just to generate income, is doing something without a belief. At some point, the probabilities are going to work against you. But that doesn't mean you can't play with stop losses or that you can't manage your risk. You can still manage your risk in response to the market moving. So I don't accept that over time this thing follows. If it was unconditional and I held it to expiration and took no intervention, yes, at some point this is going to happen. But if you take intervention, this doesn't have to happen. And if your bets are conditional, I reject this sentence altogether. Not only that, let's say that I have 10 million in long positions with beta of 1.3. And that's just simply the beta on those stocks. I wish it didn't have those betas. I wish it had a beta of 1, but it has a beta of 1.3. I have a $10 million long portfolio with a beta of 1.3. How do I get it to a beta of 1? Well, I need to add negative beta somewhere. So how can I do that? Well, I can sell calls on the index or sell calls on SPY, and I can get my negative beta in there, and I can get my portfolio down to a beta equal to 1. If the market goes up, I may have some loss on my calls, but my market is going to go up. Why do I want a beta of 1? Because I'm trying to target a certain level of volatility. I don't want this level of volatility. I want a lower level of volatility. Some people invest that way. Some people say, I want to be long equities with no more than a volatility of 15%. Okay, well, we can still get you in higher volatility stocks, but we can lower the volatility by using calls strategically. So it doesn't necessarily mean that, that you're going to lose. You could be accepting a loss somewhere for a big gain. If you believe this, you should never in your life own an insurance policy, because an insurance policy is paying for something that may not pay out, right? So I'm going to buy insurance on my house, but over a 20-year period, I may never have a fire, a theft, or anything. Well, if it's $1,000 a year, I'm going to pay 20 grand for insurance that never pays out. Those are, that's the cost of having a less risky asset. So selling calls may be the cost, like losing on it if it goes over a certain amount, losing on the calls may be the cost I'm willing to pay to end up with a less risky asset. So it's just because we see somebody do something, we cannot infer from it that everybody doing that thing is doing it for the same reasons. There are a whole bunch of reasons why this could be done. But because we are strategic, and because we can make conditional bets rather than unconditional bets, it does not follow, your second sentence does not follow from your first sentence. I'm interested in your opinion on the effect that Canadian mortgage refinancing will have on the housing market as well as discretionary spending over the next couple of years. Any mortgage struck at lower rates in 18-19 resets in 23-24. So it stands to reason the increased cost of financing household debt creates a persistent drag on growth, given that it represents around 100% of GDP. Did you mean 10%? I'm not sure what the 100% you're referring to is. Increased cost of financing household debt creates a persistent drag on growth, given that it represents 100% of GDP. Do you mean the financing of household debt is 100? Well, let's just say it's some effect on GDP. Wondering how serious a risk you think this is to the longer-term outlook for housing and the economy more broadly. I don't think it's a negative for housing. I don't think mortgage rates going higher is a negative for the housing market in the sense of the demand for housing or the supply of housing. It may be a negative in terms of housing pricing, but as pricing comes down, demand will increase because we target a monthly payment. We might say, I can afford $3,000 a month, and the combination of the mortgage rate and the housing price must equal $3,000 a month. So if prices come down with constant mortgage rates, you can afford a bigger house for the same $3,000, right? But in all of the world, I think the U.S. is the least risky here because it has the most mortgages that are fixed rate. Even in Canada, you can get a fixed rate mortgage, but it's usually for a term, whether it be a 3-year fixed or a 5-year fixed, and you have to go back and you have to renew those mortgages, only because securitization is less of a thing in Canada, which means banks tend to hold the mortgages on their books. And because they tend to hold the mortgages, they want to ensure the viability of the collateral more often and the viability of the income of the holder more often, so that you have these terms where you have to go back and sing for your supper every 5 years. But in the U.S., you can give a 30-year fixed rate mortgage because you're selling it off into a mortgage-backed security. Now it's somebody else's problem. So you originate and sell. Well, that model isn't as big in other countries as it is in the U.S. End result is, it's going to take spending power out of the economy. Well, I shouldn't say out of the economy. It's going to take spending power out of the hands of those people. But they're going to be paying interest to other people. And it'll put spending power in the hands of other people. Now, that may be the bank, but that'll show up in the level of employment they have, the people they hire, the people they pay, the amount of income they earn, the payments they make on customer deposits, because as interest rates go up, the amount they pay customers on CDs, on money that is in term deposits, 30-day term deposits, the preferred shares, the bonds, and of course through dividends, that money flows through to other people. So it's not as if that money is destroyed, it's that your interest rate has gone up, so you got $2,000 a year less to spend, but somebody else has $2,000 more because the bank has to get deposits from someone, and if mortgage rates are that high, you have to have deposit rates that high to induce those the deposit savings coming in so that you have the money to lend out. They'll get higher rates in return, and suddenly they'll start making income and they'll have more to spend. So it's going to be a shift in who gets to spend the money, but it's not destroyed money in that sense. The worst outcome is that the increased interest accrues only to those who don't spend everything they make anyways. In which case, the extra income coming into those people would not be spent, whereas the extra interest being spent would have been spent on other things. But overall, it's a risk. Usually, shouldn't higher inflation devaluate a currency? So that is a purchasing power parity argument. Purchasing power parity holds in the medium to long term. So medium to long term, 3, 4, 5 year to 10-year horizon. When you're saying higher inflation will be bullish for CAD, does that mean the expected rate hike to fight inflation will neglect PPP? It does, because this is short term. PPP is more long term. So we can think of rate hikes and then rates get cut. Rate hikes, rates get cut, right? And you can look at the purchasing power parity of your currency with another currency and you want to hold it constant. Well, there's your fluctuations around your exchange rate by differences in the returns you would get in the different currencies. One is more short-term and drives short-term behavior. One is more long-term. If so, when does this logic not apply? Well, I think I've answered that. We've seen recently in some developing countries like Turkey that inflation has led to because what they're doing is you have inflation, and for some reason Erdogan believes that we need lower interest rates to fight inflation, which is, that's just a recipe for a disaster in the end. If you want to fight inflation, what you need are higher interest rates. His argument is, but higher interest rates only raises borrowing costs. Yeah, it only raises borrowing costs, exactly, so it takes pressure off of final demand that is pushing prices up. You're not going to keep raising your prices if demand keeps dropping. You're going to start lowering your prices. It also increases the value of your currency such that your food imports and your energy imports suddenly get cheaper and cheaper every day. You get that? Your problem there isn't inflation and interest rates. Your problem is Erdogan and his belief, which is not supported. Another question concerns inflation data. Shelter in particular. I was surprised the hawkish stance shows its effects so slowly when it comes to housing due to the fact that it is driven directly by lending costs. Well, you can lower the demand for the next house sold, but that doesn't change the fact that houses had been sold before that at a certain price. And because of that, given a general market cap rate, it's going to require a certain implied rental charge. And you have a housing shortage, so that the pullback in pricing has been rather mild so far. 2714, can you please go cover how to annualize these readings and relating to discussions from your previous videos? I think you mean annualize the GDP, the CPI. So let's say you have 0.3% month over month. That is 0.003 in decimal form. Put a 1 on that. Put it to the power of 12, multiply it out, now take the 1 back out, and that's how you annualize it. Can you explain what market on close imbalances are? So there's opening and closing auctions which set the opening price and the closing price. And what the market maker will try to do is find that price where the market is in equilibrium, where you have supply and demand in equilibrium. So you want to try to balance this. So if supply is greater than demand, you start lowering the price until at lower prices, some people choose not to sell, supply drops, and more people want to buy until you get demand and supply into equilibrium. There's your opening price. So the market maker will find a price at which supply and demand is in balance. You can probably get that done on the open easier than you can on the close, probably, which is why when stocks report bad news, the stock gaps down considerably, because the market maker is trying to find the price at which supply and demand is equal. If there's way too many sellers on the open and hardly any buyers, you got to walk the opening price down and down and down until there are more buyers at that price, so that the sellers and buyers are in balance. Sometimes you might have to walk it down $15. Like look at Target today. How much did the market maker have to walk down the price to find a balance on open? When you're going into the close, if there are more sellers than buyers, you got to walk the price down into the close to try to match it. Sometimes you simply can't. Sometimes the book is set up such that there just isn't enough buyers or isn't enough sellers, so you're going to have a imbalance on the close. And for very short-term traders, that represents an opportunity that if you have a demand imbalance on close, that means there's way too many buyers for the sellers to find that closing price that is in equilibrium, that balances the market. How does the risk reversal option strategy derive its name? What risks are being reversed? The risk of your exposure. So if the market is going up, you have a exposure. You're getting paid for your risk exposure to the market. And you would want a risk reversal would mean that you'd say the risk is going to reverse, that the risk is to the downside. If the market is selling off, a risk reversal is saying that I think it's going to turn around. So right now our risk is to the downside. I think that risk will start paying a positive return instead of a negative return. So you buy a call and you sell a put, and that is called a risk reversal. What's a good source to find implied volatility percentiles? IB, options trader. Open up the window for options trader, and under setup you can have it you can have it report the IVR and the IVP, IV rank and IV percentile. Rank is can be affected by outliers. So let's say that you have volatility that looks like this, and then it spikes up and comes right back down the same day and looks like this. Well, if you have volatility that's just slightly above here on IV rank, it'll show a very high IV rank. That's why percentile is a little bit better to use, because it is not subject to outliers. It'll look at the range and say, wow, you're not that far off the bottom. Your percentile is fairly low. Whereas if you have nothing in the middle, the rank gets affected by outliers. Okay, what do you think about gold and gold miners for the next couple months? Two areas, two things that I'm not very good at. I don't know much about gold or gold miners, and this is very short term. Considering real rates are going down with the assumption that December CPI print is in line, rate hike is 25 or 50, and no other black swan event shocks from Russia or China. So this is that's a very tight forecast here. Is what you're saying is gold and gold miners next couple of months. I want you to assume that the CPI print is in line. I want you to assume 25 or 50, and I want you to assume no external shocks. I don't remember seeing you talked about precious. I was going to say, I was about the last thing. I don't remember you talked about this. It's such a narrow forecast. I don't remember seeing you talked about precious metals in general in any form of past videos I've seen so far. That's because I'm not a precious metals person. I've not spent a lot of time with it. I've never been a gold bug. I don't see the value in it in terms of why I would want to hold it, other than the price going up. And whenever there's something where, especially a bar of gold, there's no balance sheet, there's no income statement, there's no cash flow, there's nothing to assess. There's just this idea that it's scarce and it's a hedge against inflation. Well, is it? I mean, look at the inflation that we have. If it was a hedge against inflation, the thing I hear the most is it's a hedge against inflation and money printing. If it was that, shouldn't it be $5,000 an ounce by now? I mean, if gold was going to shine, this is its stage, and here it is doing nothing. So I don't buy into the argument for gold. Gold was an attractive option, at least until recent CPI. I would like to hear your opinion on the same. The easy answer to this is I don't know. I don't know much about gold. I haven't heard at any point any really good compelling reason to buy gold other than doomsday scenarios. And the doomsday scenarios is what we've had over the last 9 months with inflation and money printing, or the last 2 years basically. And gold is what? Underperforming, negative, with 1900 down to 1700. So I don't know. No idea. Would it make sense to look at the moving averages for levels of support on DXY, 50-day, 200-day? Yeah. It makes it difficult because DXY did this, right? It did this big parabolic move. So I don't know that there's a lot of information in the technicals when you have a big parabolic move like that. I'd look at them because I think that other people are going to look at obvious things. Usually support and resistance are obvious, but support and resistance on DXY is almost non-existent at this point, or very weak. You can look at the moving averages, but they'll probably be parabolic as well. So that makes them even weaker at this point. So, if you had something that did this, then the moving averages have some value, but once you go parabolic, it starts dragging those moving averages with them. The 50 would be way up, the 200 would be here. Well, if it drops like this, it's not going to concern itself with where the moving averages are. So moves like this, the technicals end up getting very weak, so you have to look at them and sort of, okay, well, be aware of where the crowd is looking, but understand that the crowd is probably not a big screaming crowd, but more of a, okay, here's the 200-day, but we get it. It went parabolic as well, and maybe it doesn't belong here. So sure, I'd look at it. I'd be aware of it, because you probably would get some kind of support or some kind of bounce off of one of those averages. But I think the bigger move for the DXY would be if the 50 crosses down below the 200, which is called a death cross. That's a big technical move. I think that's the technical indicator I would look at, as opposed to thinking that I might get support or resistance on that, only because of this particular move. Do you think the positive CPI and PPI report justify the current rally in equity markets? I don't know if it justifies the current rally, but I think it justifies raising the bottom in saying that we think the bottom of the market printed in October is probably secure for a while. I think it justifies that. I think it probably justifies, at least until the end of the year, saying that maybe 3,800 might be a good support on the index, 38 to 3850 until the end of the year. Maybe. I think it might justify that. Maybe not a rally. It seems to me the rally could only be justified if one believes a soft landing. No, I don't know that you could say that it's justified if one believes in a soft landing. It can be justified if more people believe in a soft landing than did before the CPI report. So if you had 20% on soft landing, 80% on hard landing, this 20% would have engaged with the market the way they do, and this 80% would have engaged in the market the way they do, thus the market pricing in an 80% probability of a hard landing. But after the fact, if you went to 40% and 60%, where 60% still believed hard landing and 40%, well, these people will do something. They will then commit money to the market where otherwise they wouldn't have committed money to the market, because you had some defection from the hard landing to the soft landing camp. And in doing that, you're going to create some short covering as well, which always makes these rallies really sharp and outsized in bear markets. Because not only do you have the shift in sentiment to, oh, I was a marginal seller, now I'm a marginal buyer because of this information, that will also create short covering. The suggested valuations during a recession next year are somewhere around 14 to 16. The suggested valuations during a recession, we don't know. We don't know if we're going to get a recession next year. We don't know. Let's try to state things the way we should state them, as an uncertainty, because the future is always uncertain. But we can say that valuations during a recession are somewhere between 14 and 16. Which, assuming zero growth, that'd be 225 if you assume zero growth for 2023. If you put the high end, 36 on the high end. Your logic is very sound on that. We are well above this level right now. That is true. Because the market might be pricing in some growth. Remember, this is a nominal number, right? So even if you have 0% real growth, which means in terms of quantity, you still have a nominal number. And if we think that CPI over 2023 might be 5% over the course of the year, you would have to have negative 5% in terms of quantity to get 0% growth. So the market may still be pricing in some growth in EPS purely due to inflation. Also, let's not forget energy. Energy, if you remove energy, earnings could be very negative even from a nominal perspective, but energy could really make up for it, especially if OPEC Plus continues to manage the market such that supply is just south of demand. Always just a slightly undersupplied market, you could keep earnings elevated in the energy sector, and since the market is a multiple of earnings, energy is in the market. So, you could have outsized energy earnings on that. from nat gas, which is anticipated to be high this summer, and oil prices probably expected to be high throughout probably high from here on in. As an oil company, why would you oversupply at this point only to push the price down? Do you believe that the bottom is in and will move into a new expansion, or will we see equity markets struggling through next year? Well, I think that a near-term bottom is in. I don't know if the bottom is in. No one really knows, but I have a higher level of comfort with 3,500 being a near-term bottom until there's evidence that suggests that it might not be. But right now, I would seem to think, well, I'd be if we got back down there, I think I would definitely be a buyer. I just don't know what gets us there. Move into a new expansion? Well, we don't have to move into an expansion. You could have a market that went down and now is going to go sideways for a while. So struggling throughout the next year, the next couple of quarters at least. I don't know that you're going to get a lot of visibility until the Fed is done raising. Once they're done raising, all that's rear view mirror, and all of that intellectual energy can now be forecast forward. And same with businesses that are trying to make investment decisions. They'll make investment decisions at high interest rates. They just don't want to make investment decisions with volatile interest rates. Okay, first question, top of the screen up here. I've been listening to the Rational Reminder podcast, and they seem to be advocating the benefits of low-cost index investing. Your thoughts on this would be highly valuable as you are primarily an active investor. Well, when you're talking to a retail investing market, it is a safe assumption to assume that 90 to 95% of them are unsophisticated, are investing their savings and have a career. That is a safe assumption to make. People like me are very rare, that are very experienced and manage their own money and can beat the market. When I say beat the market, I want to be very clear as to what I mean when I say that. Whatever the return on the S&P 500 is each year, I can beat that. But I go outside of the S&P 500 to get that done. So you can make the very valid argument that if I do that, then the S&P 500 is not my benchmark. My benchmark would be something that could replicate what I do in a passive way. So that would be the first criticism of saying, oh, a retail investor can beat the market. Sure, you can beat the market, but you'd be investing outside of your benchmark. Beating the market means if your S&P 500 is your benchmark, you only invest in the S&P 500 and you're not using options. And that you're going to overweight and underweight certain securities to get a better return than what the market could deliver. That's brutally hard to do. But as a retail investor that's free to travel anywhere they want and invest in anything and buy and sell and use options, it's not a difficult task to beat the market. It even making few decisions, just a few, you can beat the market, but you are investing outside of the benchmark. So it's not really it's not that great of a statement to make to say I beat the S&P. Well, sure you can. If you're allowed to invest outside of the S&P, probably anybody can do that. What could a professional do? But these guys here, I've never heard of them, I've never listened to anything they've done, are probably talking to an audience that is not me, that I'm probably not their audience, that the local dentist or my dentist 2 doors down, 3 doors down from me is probably their market. They don't want to sit around all day long making investing decisions. They're punishing people sitting in their chair and torturing them with drills and needles. That's his job. He's a torturer. He doesn't want to sit around and do this kind of work. As a retail investor that is unsophisticated, meaning that their primary knowledge is not the markets, be passive. Buy something else. Let somebody else manage it for you. I absolutely agree with that. You're only going to get into trouble by listening to other people or hearing a stock tip somewhere. There are no stock tips, by the way, but hearing a tip somewhere and investing, because you're not going to know when to exit. You're not going to know what it is. I agree with the passive side of that. Let's see. If you had bought a treasury bond about a year or two ago when gross redemption yields were 0% and continued to hold until redemption of the bond, then your return would, of course, have been zero. Not really. Or worse, as a worst case scenario, not really. In a rising interest rate environment, if you are buy to hold, you will get more than your yield to maturity when you bought it. So if you bought it at a 1% yield to maturity, every time you get your coupon, you're investing at higher and higher rates. So your yield on your initial investment will be higher than the yield to maturity because your reinvestment will be at higher and higher rates. Not a lot, but it will be. If you instead had purchased a bond ETF, you would be sitting on decent sized loss. Well, a bond ETF is a portfolio, and the portfolio will have an IPS, and the IPS will have some kind of target duration. So if it is a 10-year, let's say a 10-year ETF where the bonds in here are anywhere from 6.5 to 10 years, well, that's it. It may have a target duration of, let's say, a 7.5. And as each day goes by, that duration gets lower and lower and lower. So you do have to sell off the bonds that are closer to 6.5 years, and you do have to keep adding bonds in the first, that are closer to 10 years to maintain your target duration. So in rising rates, you will be selling at losses. Yes, you will. But you're maintaining a duration. That's the point, right? Is that somebody is using that security because it has a very specific duration and they want that duration. Otherwise, it's not a suitable bond fund for them. But that is the duration that they're attempting to target. Now, while they do bad in rising rates, they do very well in dropping rates because they didn't buy a 10-year bond and then wait for interest rates to drop when it was a 7-year bond. Well, they've just given up 3 years of duration by having a constant duration. It's not so much that you're buying and holding it because it's a bond fund, but it allows you to time interest rate hikes and contractions better. So once the Fed is done raising rates and is going sideways for a while, there is a good time to add duration. Because you will have been buying the bonds hopefully at the lowest price, and as rates drop, they will go up in price. It's not always the case that the lowest price happens at the highest federal funds rate, because the market may anticipate the end of the rate hiking cycle and start buying duration ahead of that, which means the 10-year, 20-year, 30-year bond could start going up in price even if the front end of the curve keeps going up in price. There's your inverted yield curve, right? Is this because bond ETFs sell bonds before? Okay, so you got all that. How are U.S. Treasuries traded on IB? You just there is an icon at the top of the screen in IBKR that you just click on, and you can select your treasuries that you want, and you can initiate a sale. I don't think it's possible to trade direct on exchange. It's not on an exchange. It's a dealer. Market, not an exchange, so it's not on any one exchange, but you can trade it through IB. Market makers, dealers, whatever you want to call them, but they are there on IB. I understand IB will credit 100% of the face value back at redemption. Well, it's not that IB is crediting you, it's the Treasury will give you your money back. IB is just saying, okay, that money goes into this account. It's not as if IB is doing it, but I get what you're saying. Treasuries, I'm not sure how tips work, but let's say you bought a 1-year tips, just to make it easy, and inflation over the year was 8%, you'll get 1,080 back. The bond increases with the rate of inflation, and you have a real coupon. Let's say your coupon is 1%. Your coupon, every time your coupon is paid, is on the increasing amount, which means your coupon is increasing at 8% as well, which means both your coupon and your principal are increasing at the rate of inflation. That's why they're called a real bond, or a real yield bond. Okay, could you detail any implications you're using a Taylor rule, modified Taylor rule, Bernanke rule, Yellen rule, target rate models for predicting where the FFR should be? Well, they're not so much prediction models as prescription models. So they don't predict, they prescribe. They're models that suggest that, if you're concerned about certain things, this is where the short-term rate should be. Sincero currently pointing 7 to 9%. Why is FR lag? Thanks. Well, here's a timeline. Here we are today, and you observe inflation. Inflation is year over year, right? Whereas the interest rate is for money earned going forward. So if you want to see where the FFR is in relation to inflation, you're also going to need a forward look for inflation. So the Taylor rule should use pi e, expected inflation. So I'm not sure if you put in expected inflation or observed inflation. If you're putting in observed inflation, you have a mismatch. You have a backwards looking measure with a forward looking measure. So you're going to have to put in your expectation of inflation, and that would be, well, we don't know the future. It would be a probabilistic or a subjective number that would be in there. Thanks again for weekly update. Just to add on the China COVID cases topic, first of all, could we trust the number they published? I don't know what level of trust that I would put in there, but there is skepticism. Although they are showing elevated numbers of COVID cases. I don't know why they would want to not tell the truth about that. Said another way is, if you're going to lie, wouldn't you make them smaller instead of bigger? I know I wouldn't. Second, one of the major cities has announced last week that no more COVID tracking or lockdown. The city is 1 or 2 hour driving time to Beijing. China's not going to lock down again. My thinking is that inflation pressure would release quite a bit. That's a supply chain argument, right? If you are making a demand side argument, then inflation would you'd have upward pressure on inflation, because that would lead to increased demand. Maybe 1-2 months later, Fed will have more confidence that inflation is being controlled. Once new CPI and PCE confirm that, which could lead even earlier rate hike pause. Well, we think we're going to get a rate hike pause in the next month or two anyways. So I don't know that it would be an earlier rate hike pause, but a more justified rate hike pause. If so, I'm thinking along XLP, that's consumer staples, to bet on improving cost and margin for defensive sector, and agency on reduced interest rate volatility and credit spread. Just in case I'm wrong, I would also play short position on SPY or cover calls in my positions. I wouldn't do a short position on SPY just to hedge against XLP and agency. Let's see what your thoughts are on that. Agency, you got a good income stream on agency, and on that one, you know, that really comes down to two things, right? It comes down to where the 10-year Treasury rate, where you think that's going to be, and where the spread between the 10-year and MBS is going to be. So if you think that the spread will contract over time, regardless of what would happen, you know, even if rates go up a bit, if you do believe that they're going to level off soon, that spread would probably contract, and you might have seen the high in the 10-year, in which case, yeah, it could be a safe place to be. I don't know that agency would go up with a flat term structure on rates. I shouldn't say term structure, but with the 10-year being flat. But as soon as it starts retreating, it would increase. And since agency has no housing market exposure, which sounds odd, right? It has MBS. How can you say it has no housing market exposure? These are mortgage-backed bonds. It's not related to the level of mortgage activity going on. So even if the housing market drops a bit more, these are bonds. And it's not dependent. The bonds they hold are not dependent on new housing sales. New housing sales may mean more supply of bonds, but you know, the value of the bond is not dependent on home sales. Okay, 2 up here and 1 down here. Long questions, tried to get them both on the same screen here. I think I answered one already about S&P valuation. Given the 225.2 earning forecast and 14-16 average PE multiple in recessions, we will reach the price of 31.50 to 36.03. But the 225.2 earnings forecast, do you think it's the worst case scenario, or can it go even lower? Yeah, it can go lower. And given these circumstances, does it make any sense to buy S&P at a price like 400? I'm leaning more towards a no, just purely on valuation issues. But that doesn't mean the economy can't improve to support those earnings. At this point, there's just not enough visibility. So we just have to be aware of the distribution of possible outcomes. And I don't know that higher makes sense now, given the uncertainty ahead of us. So, as I said on Sunday, the higher we go, the more valuation issues will dominate the conversation. About the Chinese economy, Louis Martinez from the University of Chicago published an article and argued that their economy is a lot smaller than what they actually report. Interesting. What are your thoughts on that? I haven't read it, but that's an interesting statement. I'm asking this because some Chinese... Actually, you know what? Let me back up. I have heard that report before. I have heard it on the basis of how things are... not so much how they're counted, but who's responsible for what and who doesn't want to be in trouble. So there are times where there's these transactions between districts for doing nothing more than increasing the volume of activity between districts. So yeah, I have heard rumblings of that before. What are your thoughts on that? I'm asking this because some Chinese equities are at some interesting levels. And I'm making the assumption that the government would eventually ease the pressure on the COVID-0 policy, hence this would be a positive factor for those stocks. Well, you're saying two different things in here. You're saying it's a lot smaller than what it actually is, but there are some stocks that maybe might benefit from increased activity. If these stocks are pricing in the false growth or the false rates and not the real rates, then it calls into question the whole valuation of their equity market altogether, regardless of what's going on. So I guess I would push back on this and say, well, which one do you believe? Do you believe this person and think that there is something there, or do you ignore this and say, hey, the valuation of some stocks might go higher because this kind of thing would happen as COVID restrictions would ease. You can't hold both of them at the same time and bet in the same direction, right? So which one do you believe, and go with that? How do you determine the appropriate valuation for a REIT? It depends, but it's usually some multiple of FFO or some multiple of AFFO. I see some REITs trading at a constant discount where others are more likely to trade at a premium. Yeah, I've seen that too. Slate Office REIT. Okay, well, office is very particular because of all of the REITs that have reported, the office REITs were more likely to print negative NOI quarter over quarter and year over year. So negative NOI growth. You're not going to pay a premium for that. Trading at a discount of 51.4 discount to NAV at the end of Q3. Well, NAV is based on a property value, the fair market value estimate of their property. I'll just write investment, I'll just write property. Well, you need a fair value estimate on that, and that is what it is, an estimate. So, NAV is made up of what they think fair value is. That may not be true. Rents are currently at market discounts. That is true, providing further upside, potential further upside. If you're below the market value, there may be a good reason why. It doesn't necessarily mean that you'll get market value. It just could be, locations that aren't suitable, dated buildings, or just poor management. Their occupancy rates have more room to grow. True. Majority of their tenants are government, have strong credit, and they are acquiring new properties at big discounts to replacement costs. Their distributions, although pretty substantial, seem sustainable over the longer term. Yet the analyst target price within the range of 425.5. What am I missing here? The environment. It is situated in an environment, and office REITs have a challenging environment right now. Plus, this particular REIT has a fight brewing within it. The largest shareholder is waging a proxy war against the management team, and Slate Office Properties has an external management team, not an internal management team. That can be a problem because the external management team it doesn't have interests aligned with the shareholders to the same degree. They get paid no matter what. So there's a lack of alignment. And the proxy battle points out some mismanagement that Slate Office Management, the external managers, have done. For instance, the last building they purchased issued sort of unfavorable securities at an unfavorable rate, which they didn't really need to, and they weren't really clear as to what the purpose of the fundraise was for. So I kind of agree with that. I think it's time to look at the management of SOT. They've had been trading at a discount to NAV for quite some time, and their share price just keeps going down and down. They maintain their distribution, so they are a cash generator in the portfolio in that sense. But at some point you have to turn all of that latent potential into an actuality. You have below market rents. Well, yeah, that's a potential, but somebody has to turn it into something. You have less than full occupancy. Yeah, that's a potential, but somebody has to turn it into something. But it's in office space, which is challenged right now. It's not the best environment for office space. So, I think it's more a function of the type of REIT being office REIT than it is anything else. I think that's a big problem. However, they have had years of questionable performance in terms of their relationship with NAV. Maybe their dependence on equity issuance for future growth, since most of their cash is distributed. Yeah, you could say that, but I mean, they are selling properties and buying properties, right? Those are called asset swaps, where you're trading one asset, you're selling off one asset to get into another asset. The selling of one asset should generate the cash flow to move into the next asset, especially if you're selling the one asset that you've upgraded in terms of its quality, the quality of its tenants, the level of its rent, the length of its leases. It should have some kind of self-financing in that respect. If you're simply just adding properties, yeah, you're going to need equity issuance. But if you're just managing your portfolio of existing properties by selling assets that have appreciated or that are worth more than what you paid in buying other ones, you shouldn't have to continually issue new securities. How would a margin call scenario look like for a private company like Twitter? If the value of the equity drops, how would that be measured? This is no longer publicly traded and there's no observable market price. What are the covenants in place for debt financing provided the Twitter acquisition that would constitute a margin call? It's called, your margin is based on the value of your collateral. And if he posted Tesla shares as collateral against the loans to buy Twitter, the value of Twitter doesn't matter. It's the value of the collateral. So if Tesla falls to a certain price, the value of the collateral is dropped, you would have a margin call by having to post more cash. You'd have to sell shares, either add shares of Tesla or sell shares to add cash for your margin call. So, if you borrowed $1 billion and you posted $1.5 billion of Tesla stock, you might have a margin call if the stock dropped to $1.2 billion, which means you would have to do something, right? So it's not that the value of Twitter would force the call, it's the value of your collateral. Typically, if you're borrowing money for something, the something that you're borrowing money for becomes its collateral, such as the price of a home. But if you're borrowing money for your private business, you may post public shares as collateral against the loan for something that has no value yet. And the bank is willing to lend you money against collateral that has value, but may not be willing to lend you money for a venture it doesn't believe in, or that it is not positioned to lend money to, which would be what a venture capitalist might do. I anticipated a big move on CPI day, so I put bear spread as well as bull spread, anticipating a $10 to $12 move in SPY. My cost based on two different bull spreads, $390.95 for 26, $390.400. The bear spread, $390 to $400 is a 10, $390, $395 is a 5. Okay, I don't know what you're doing here, but anyways, the bear spreads cost me the same amount. Soon after the market opened, I closed all the positions for a net profit. Okay, had I held the position till the end of the day, would my profits have been a lot higher? Till the end of the day, would my profits have been? I don't know. I don't know what you did. Is this a question or is this a statement? I guess my questions would have been a lot higher. Approximately 1,600. Okay, so you took 530 and you could have made 16. But at any given time, the future is unknown. All you have is the information you have and the profit you have and the feeling you have about that profit. But yeah, you could have made more. I saw the CPI numbers were lower than expected. I knew the market would think the Fed would have to start being dovish, which is what fueled the rally. All I could think was that the Fed is not going to let go easily, as their target is 2%, but we're way above that, and they are expecting a consistent downward trend. So I proceeded to sell my positions. I do accept that I was in a hurry to book profits, which cost me the opportunity to make more. While I looked at the macro picture and made a decision, the dynamic sentiment of the day were different. What are some of the trading indicators or parameters to check on a given trading day to understand whether the rally fall will hold or not? There's also been an instance where I had call spreads, market rallied, I sold, and the market went down. My problem is that in both cases I did not know the kind of trading that was happening for the day. How can I improve here? Is there a discipline to inculcate? Could I have done anything differently? Well, that's only experience. A day, when CPI day came and the market was up, you were not going to end with a down day. It was too broad based. Everything was green. So you should have a number of screens where you have stocks on the screens. Not so much that you're interested in the stocks, but the stocks are sort of like a barometer of a particular sector. So you may have 8 or 9 screens open representing different sectors of the economy, both strong and weak stocks in there. So that what you can do is you can click from watch list to watch list and just look for the green and the red. And if you're seeing green everywhere, no red, you're seeing green, even the weak ones are green, that doesn't end very easily. So those kind of days continue on. I guess a good way to ensure that your profits last is, so you book profits of 530. Is there a big difference between 530 and let's say 450? Taking $450 is still a pretty good day, but you got 530. And if you think, well, 450 is still a good day, put your order in at a trailing stop. Use a stop, a trailing stop of, let's say that you put your spread in, and I'm just going to make up a price. Let's say that your spread, you're saying here was 26 cents on the 390, 395 call, 0.26. And the most it could be is $5, but you'd have to wait for expiration on that. But you could, in the morning when it opened up, maybe it was $1.40, let's say the spread. Well, you could have put a trailing stop of 30 cents, which means your stop would be $1.10. So if it dropped down, you'd get $1.10. But if it went to $1.50, your stop then moves to $1.20. If it goes to $1.60, your stop then moves to $1.30. And you trail just behind the price, so you get knocked out whenever, if it goes from $1.60 to $1.50, your stop still stays at $1.30. So you get stopped out there. This allows your upside to run while your stop sort of just trails along, but you got to watch the volatility. There wasn't a lot of volatility that day. The market went up and it didn't give back. It hardly gave anything back and finished hitting the highs into the close. And if that's the case, by the end of the day, your trade probably still wouldn't have executed because it wouldn't have hit your trailing stop. Then you could have stepped in at the end of the day and closed it. Experience and intuition will tell you when to hold. Well, it won't tell you when. It'll give you a feeling as to when you can hold and when you should exit. I even have problems with that. I'll exit some positions that I think that have run its course only to see it go higher the next day, and I think, why didn't I just put a tight stop? So if something hits $16, let's say, and I think, well, I don't think it's going to go any higher, rather than sell, it'd be easier to put a 15.80 stop with or a 20 cent trailing stop. Which means if it opens the next day at 16.20, my stop is now 16. If it goes to 16.50, my stop is now 16.30. And then I let the market determine when I'm out by using that trailing stop. So you could have done that. Let's see. Did I get everything here? What are some of the trading indicators to check? Trading to understand whether the rally will fail or not. Problems book. Okay, I did answer that. Okay, there we go. Okay, this will be the last one here. There were just too many this week. As you know, emotions are our enemy in investing, and I want to see how you manage them. I'm pretty much emotionless when it comes to the market. I find things interesting, but I can't remember the last time I got frustrated or angry. From your roll up and forward strategy, it seems you were okay taking a loss on the short call. I rolled up my puts. My puts were at a profit and I rolled them forward. I didn't roll my calls. My calls are still November calls. My puts are now December puts. I will decide by Friday whether or not I want to end up with a short position in SPY by having them exercised against me, or if I want to roll them forward. It depends on the premium that I can get versus the cash I could earn on the money I would receive by selling SPY. Let's see. However, I find myself not wanting to take a loss on the option. Said hope is not a strategy, right? That's not a strategy. You don't want to take a loss on the option by rolling them forward. You're not taking a loss on the option. That's the whole point. You're rolling them forward. So let's say you have a 380 call for November 18th expiration. Let's say that when you sold it, you got $10 when you sold it. And let's just for argument's sake say on November 18th the market is at 395. Which would make the 380 call worth $15 because there'd be no time value. And let's assume that it's just trading at $15. You have a $5 loss. And you think, well, I don't want to take the $5 loss, but you're not. If you roll forward to a 380 December call, you're going to get the $15 plus time value of 1 month. So if you are waiting for this to get back to 380 by November 18th, what's the difference between waiting to November 18th and waiting to December 16th? You still sell the same call at 380, you roll it forward, and you'll get more time value. Right, so you have that, which means that let's say that you get $18 for doing it. Well, you have lost $5 by rolling it forward. You have a realized cap loss of $5, which means your break even on the whole thing is, because you got an extra $2 here, your break even is when the value of this gets to 13. So if you close this at 13, you make 5, you lost 5, your break even just happens to be lower. If you're going to hold it and hope that it drops, and if somebody said, well, what if I gave you to November 25th? Would you like that? Without having to roll, you'd say, sure, I'd like that. Give me an extra week. Well, that's the same as rolling. That's all it is you don't be too concerned with your transactions. Manage the portfolio, not the transaction. If you see this as taking a loss, you don't want to take a loss, but rolling it forward is not taking the loss. You go from 380 November, well, now you're 380 for December. You have more time. Yes, you have a realized loss, but you're going to get the full premium. You're going to get at least $15 here plus some time value. You're going to get more premium in for waiting, which means that your break even on the upside might go a little higher because you got $10 when you sold it here. You got 18, let's say, when you sold it here. 15 was intrinsic, but 3 was time value. So now you have 13. Your break even is 393, which is the same as saying 18 minus 5. If you're selling it at 13 on the 380 is 393. Rolling it forward just buys you more time. Yes, you're going to have a realized loss here, but again, if you sell it at 13 over here or close it at 13, you have a realized gain of 5. These offset each other.